Right then, hello everyone, and just another update from us at the end of a pretty wild second half of the week. Monday, Tuesday, Wednesday was a little bit boring across most of the major markets. We did start the week sort of on the back foot Monday morning. I mean, there was reports of China reducing their COVID restrictions and then not reducing their COVID restrictions and then reducing them again. We've settled on that at the end of the week, them reducing the restrictions on travellers. Coming in and out of the country, but the lockdown measures, the zero COVID policy will still remain in place as the virus mutates and still spreads across the country as they have put it. Apart from that though, that's kind of taking a back seat though as we got into the back end of the week. Monday, Tuesday, Wednesday, not a great deal. Sorry, I'm still on the calendar from this week. Sorry, my bad, from next week. Back to the calendar for this week for a second. If we have a quick look across the calendar then for this week, Monday, Tuesday, Wednesday, as you can see, pretty quiet. Not a great deal of information out. Certainly nothing over this side of the world. As we come into yesterday though, into Thursday, we had the CPI prints out of the US. Now these are kind of the most important figures on the calendars. These take priority over NFP, over the labour market figures. Certainly now, while the Fed is in a hiking cycle, hiking interest rates to calm down or cool down the rate of inflation. We can see the CPI print, so the total rate of inflation, the total CPI print here, as you can see, last month 8.2, consensus was for 8%, and actual 7.7, so a 0.5% decrease in the total CPI print, including food and energy. Then come across to the core CPI print, excluding food and energy, which they say is a better gauge of the economy as a whole. Pulling back 0.3%, right? Previous 6.6, consensus 6.5, actual 6.3, right? What that does is then it opens up the door for the Fed to slow the pace of rate hikes. Money markets continue to price in then a 50 basis point hike in December, which they did allude to at their last meeting, but they did say the terminal rate would be higher. But this does give them a bit more of a reason to slow down the pace of rate hikes and then stop hiking rates potentially a little bit earlier. But you've got to read into these figures a little bit more than what we saw yesterday. Obviously, sizable decreases. It is only 1 month, certainly in terms of the core CPI print, but it is only 1 month, right? If we just go back to the medium impact on this calendar, anyway, we'll come back into yesterday, come into Thursday, and we look at the monthly figures, right? We look at the monthly figure. This core CPI print, right? The month-over-month figure for October is still at 0.3%. Not as high as the 0.5 that we're anticipating, but it's still at 0.3%, right? If that was to continue at this rate with 12 months then in the year, that's going to result in a 3.6% core CPI print, which is still way too high. Right, that's still way too high. You look at this inflation, the total rate of inflation, the total CPI print, that would end up 4.8%, 4.8% for the total rate of inflation across the US economy, which again is still too high. So, markets did enjoy these figures. They did like these figures, and saw some massive moves yesterday. But I think we've got to hold our horses a little bit in terms of the progress on inflation. If those numbers, the month-over-month figures, remain the same into December, over the course of November, and then we get similar figures then in December, we've still got more work to do. You still got to continue to hike rates to cool down inflation. You still got to wait for the rate hikes to take effect. So, I mean, whether markets get ahead of themselves or not is not really what we're trying to figure out. If markets are bullish for a certain reason, then you can continue to buy. If the dollar is bearish for a certain reason, then you can continue to sell. But a lot of market participants think that's the peak in terms of the CPI prints. But if these month-over-month figures continue to rise at this pace, it does continue to pose some problems for the economy going forward. We've got these GDP prints, preliminary figures out of the UK, negative, giving us negative growth, right? Consensus for minus 0.5% over Q3. Actual was minus 0.2, so not as negative as markets were expecting, but that is still the first step to a technical recession, although a lot of the data that we've been getting out of the UK recently does point towards us already being in a recession. But obviously the term for a technical recession is 2 consecutive quarters of negative growth. This is only a preliminary figure, it's not the final, but they're normally pretty close. And obviously that is step number 1 of a technical recession in the UK, which the Bank of England did tell us at the last meeting that we are to expect possibly an 18-month long recession. But there's a bit more to come out next week in terms of the UK, in terms of sterling, which we will get back to in a minute. But we'll flick across to the charts then. We can see the reaction. We see the reaction across markets. We can see this dollar index, right? Biggest downside day in the dollar index for 10 years. Biggest downside day in the dollar for over 10 years. We also did have that last Friday as well, the biggest downside day in the dollar for 10 years. So, we just had a slightly bigger downside day yesterday, and that's continued to push lower over the course of this morning. We're down 60 pips on the dollar index itself. You can see dollar weakness across the board. This top half of the thing, $3 pairs down, dollar block all higher. That would then suggest it doesn't suggest, it just tells you that the dollar is lower. Right, obviously a contributing factor to that is this US 10-year yield, which had a massive down day yesterday in terms of yields. Now that yields, that chart will be a good indication of where markets will head from now on. As I said, money markets have priced in a 50 basis point hike for December, so we need to keep an eye on this 10-year yield going into the future. We are through a couple of these lows, so you can see loosely, if you are that inclined to do technical analysis and this sort of thing, there is a bit of a left shoulder, head, right shoulder, if you want to read into it like that, and then pushing lower through these lows here. Pretty solid technical break on the US 10-year yield, and that really there's not much around till you get down towards these sort of lows down at 350, 360. So definitely keep an eye on that US 10-year yield. Nothing in the way to stop it in terms of technical levels till we get down to 350. So are we on for a test of 350? If that continues to push lower, the dollar continues to push lower, and then stocks continue to push higher. Obviously a massive upside day in stocks as well. We just get the measuring tool out quickly and have a look. 6% upside day in the S&P 500, which is not something you will see very often in your trading career. Right, 6% upside day in the S&P 500 is not something that happens very often. So definitely a sight to behold yesterday. I don't want to say markets get ahead of themselves, because if that is the peak in inflation, then that is obviously positive for markets. But the month-over-month figure still at 0.3%. I was a little bit surprised at the magnitude of the move. Obviously, you'd expect a good move. You'd be able to take some profits off it. But in terms of the fact that S&P ended up nearly 6% higher yesterday, pretty insane if you ask me. And then the other bit of news over the course of this week, just flicking through the cryptocurrencies, you can see across the board, whether you look at it, Bitcoin, Ethereum, Cardano, Ripple, any of these cryptocurrencies, they've all been absolutely smoked this year off the back of FTX facing collapse. If we just get the FTX token up, have a quick look at that. That is approaching zero and approaching worthless. It was up 25 earlier on this week, and then on Tuesday we had the news that FTX was struggling. FTX was struggling, running out of cash, and they were unable to process withdrawals at one point. They continue. Sam Bankman-Fried continues to say that the withdrawals are still possible, but that has sent shockwaves throughout the crypto markets off the back of one of the bigger exchanges potentially collapsing. Right, he's looking for $9.4 billion just to save the company. I don't know how on earth he's going to get $9.4 billion. I don't know why you'd invest in that at the moment, but he does himself face a probe into his dealings from the SEC, and that's how the ripple effect across markets. Crypto exchange BlockFi has paused withdrawals due to a lack of clarity from FTX, and it just shows that if you are holding cryptocurrencies, a lot of these brokers are still unregulated, so you need to if you do hold cryptocurrencies, if you are one of those people that holds cryptocurrencies, you're probably not making much cash at the moment, but you will want to get them in some sort of a wallet. You don't want to be holding your cryptocurrencies with these unregulated brokers, as they can get you into a bit of trouble. We see when cryptocurrencies sell off heavily, people, these crypto exchanges, they pause withdrawals, they stop selling, just off the back of being unregulated. They don't really have the same rules and regulations as the other brokers. So be interesting to see how that plays out. I was reading a thread from him on Twitter last night that he just doesn't know what's going to happen with the company and where the company's going to go. He's pretty honest if you look at his Twitter feed last night. I presume the thread's still up, but he says the next few days, the next week or so will be important in terms of the company, but that company is facing massive problems, and his billions of wealth have been wiped in a matter of days. So he's in a bit of trouble. FTX is in a lot of trouble. The cryptocurrency markets is in a bit of trouble. Did have a bit of respite yesterday. If you're having a look at some of these cryptos across the board, Bitcoin had a solid upside day, just off the back of risk assets pumping. That is slightly lower again on the day. Be interesting to see if that rally yesterday can hold, or whether this continues to move lower into the weekend. Well, obviously weekend trading is still is doable across the cryptocurrency markets, where it is not on more of the more established markets. But that's that then. We'll have a flick across into next week, have a quick look into next week, and we've not got too much information out across the world. It is then we've got some UK figures out on Tuesday, some labour market figures on Tuesday out of the UK, some inflation print out of the UK on Wednesday. But really, this UK fiscal statement is the main focus of attention into next week. We're obviously expecting a recession across the UK, potentially lasting for 18 months. How deep that becomes and how long that lasts for may be decided by this fiscal statement out next Thursday. So there'll be a lot of eyes on that next Thursday. Hopefully it will give us some direction on the price of sterling, although it is considerably under pressure at the moment. Apart from yesterday, it was up 300 pips or something yesterday, but that was not off the back of sterling. That was off the back of the dollar. And what that means going into next week in terms of assets across the board, you'd have to imagine risk sentiment stays firm, stays positive into next week. And I think long stocks and short the dollar seem the way to play it on face value. But that US 10-year yield is important. If that pulls back and starts pushing higher again, and markets start to speak about the fact that the monthly CPI print is not as low as it needs to be in order to have a sustained level of inflation, then that might turn around. So keep an eye on that US 10-year yield. But with that CPI print this week, you do need to remember that if we get a 0% core CPI print or a 0% CPI print in October of next month, that still means we're paying today's prices. So in order to cool down inflation is going to have to go into negative territory, and we are still a long way off of that. Do we get some Fed speakers? Do we get some members of the Fed out speaking? Give us some clarity around that. But markets liked it yesterday, but there's still more work to be done. But that is it from me then. I'm going to wrap it up there then. I will let you get on with your afternoon. But from us then at LAT, if you're listening from America, I believe it's Veterans Day. Have a nice day in America. It's also Remembrance Day here in the UK. So enjoy your day, enjoy your weekend, and we'll be back next week for another week of trading. Thank you.